Okay, let's unpack this. If you're trying to make sense of the financial markets right now, you might feel like you're experiencing a kind of investment schizophrenia.
That's a great way to put it.
On one hand, you've got this maximum optimism, money just pouring into high-flying growth stocks.
And on the other, maximum defense, a huge rush into gold and other systemic hedges.
Exactly. These two forces are just fighting for control, and it creates this highly complex yet deeply fascinating landscape.
And that tension is really the defining feature of the financial environment as we step into early 2026. So this deep dive is all about synthesizing the high-impact financial data from January 7th. Our mission is to analyze the market's fundamental base layer, this layer defined by persistent, middle to high long-term interest rates that are just colliding with these extremely sensitive short-term liquidity fluctuations.
And then we track where all that capital is going, how it splits.
Exactly, how that capital flow diverges in response.
We're pulling knowledge from all the latest reports, focusing on the macro pressure, the spectacular movement in AI and tech, and that simultaneous, equally spectacular demand for safe haven assets. This isn't just a readout of yesterday's trading. This is, it's the operating manual for how capital is navigating the uncertainty of this first quarter.
Yeah.
So let's start with that bedrock layer, the macro pressure points. The first structural fact we just have to deal with is this unrelenting interest rate environment. We're looking at the U.S. 10-year Treasury yield, which is acting like an anchor stuck in cement. It's hovering stubbornly in that, 4.17 to 4.19% range. It is refusing to give way.
That refusal is absolutely critical. This prolonged maintenance of middle to high long-term rates creates what we call, structural gravity.
Structural gravity, I like that.
For growth assets, particularly those that are reliant on future earnings discounted back to today, this rate applies significant, sustained downward pressure on their valuations. It forces investors, it forces analysts to really ruthlessly audit which growth stories genuinely justify these high multiples.
The easy money days are long gone.
Long gone. The market is being told daily that the high cost of borrowing isn't going away quickly.
And that high cost isn't just structural. It really reflects the Fed's dilemma, right? We have this contradictory data set coming in. Reports show that while core inflation has retreated from its highs, it's still frustratingly sticky.
It is. It's refusing to drop below that comfortable threshold the Fed is targeting.
And that's being propped up by the labor market.
Exactly. And that stickiness is being supported by a labor market that just won't quit. We're not seeing the cracks. We're not seeing the severe cooling the Fed might want to see to justify, rapid rate cuts. The labor market shows continued stubborn resilience.
Wait a second. If the labor market is strong and inflation is sticky, why is the market sentiment still constantly trying to price in aggressive rate cuts for later this year? Isn't that a huge disconnect?
It is a profound disconnect, and it highlights the internal conflict or divergence within the Fed itself. Some members are highly concerned about lagging indicators and price stability, which keeps them hawkish. Others worry about pushing the economy into a recession by holding rates too high for too long.
So the market's just guessing which side will win out.
Constantly. And that's where we're saying the upcoming hard data, the next non-farm payrolls, the ISM reports, along with every single public speech from a Fed official, becomes a massive driver for short-term rate pricing.
Okay, so that sets the long-term stage. But now we have to talk about the short-term plumbing, the liquidity issue that gave us this really sensitive glimpse into the system's nerves back on December 31st.
Yes. This is where the short-term mechanics collide with that long-term rate stability. We need to zoom in on the New York Fed's year-end activity. That day gave us two staggeringly large data points. First, usage of the standing repo facility, the SRF, hit a record $74.6 billion. Second, on the very same day, the overnight reverse repo, or on-an RRP, saw an inflow of approximately $106 billion.
Okay, let's clarify that for everyone listening, because those acronyms are dense. What do those two things actually do, and why does it matter that they both hit record highs at the same time?
Excellent point. Think of the financial system's cash flow like a plumbing system. The SRF is essentially the Fed acting as a lender of last resort. It injects liquidity into the system.
Just putting cash in.
Right. It takes collateral from banks, gives them immediate cash. High SRF usage means banks needed that funding, even if it was temporary. Conversely, the on-on RRP is a tool the Fed uses to drain liquidity. It gives money market funds a place to park excess cash overnight, effectively taking that cash out of the system.
So a record amount of cash was being taken out, and at the same time, a record amount of cash was being requested by banks. That sounds like chaotic plumbing.
That is the perfect analogy. And while the market mostly viewed this as, passive seasonal scheduling,
Just year-end cleanup.
right, balance sheet window dressing, those record numbers really highlight how sensitive the short-end funding market is. Even if it was scheduled, seeing record activity in both the injection and the absorption mechanisms, it signals an underlying volatility. It reinforces that this high-rate environment is coexisting with a very nervous, fluctuating short-term cash market.
All right, now we follow the money. This is where that market schizophrenia really becomes visible. Given this complex macro backdrop, early year trading volume has been thin, which tends to amplify movements, and the data shows this dramatic, paradoxical split.
It does. Money's pouring into AI and technology growth, but at the same time, it's rushing into precious metals and safe haven assets.
It's like the market is taking out maximum insurance and placing a maximum risk bet at the exact same time.
That's it. Let's start with the growth side, which is just dominated by the AI infrastructure theme. That is the undisputed core catalyst.
And you see this immediately in the semiconductor space. NVIDIA is trading strongly around, 188.8? It just keeps benefiting from this belief that they are the primary pick-and-shovel provider for the AI boom.
And then you have the secondary large cap beneficiaries. You have Meta near 650 and Alphabet trading in the 310 to 320 range. And they're influenced heavily by their own internal AI strategies, along with, the overall health of the digital advertising climate.
But I have to bring up that structural gravity again. I mean, how long can NVIDIA and these other high flyers sustain these kinds of valuations while the 10-year is stuck at 4.17%? Does the market just believe AI is immune to the cost of capital?
Well, the market is currently betting that the magnitude of future cash flows from AI outweighs the immediate discount rate pressure. It's a massive long-term bet on market capture, scale, and productivity gains. But you are asking the critical question. This is why the broad-based ETFs are such important anchors. The S&P 500 ETF, VOO, around 636, and the NASDAQ Q100 QQQM in that 255 to 256 range.
They're consolidating at high levels, sure,
But their performance is increasingly concentrated in these few highly rated semiconductor and mega-cap tech stocks. If that AI thesis cracks, those anchors will be severely tested. But as you pointed out, capital isn't just going into rockets, it's also building bunkers.
Precisely. The other side of the coin, the rush into defense. Spot gold is trading exceptionally high, hovering around $44.85 to $44.96 an ounce. It's approaching record highs. Why is gold so strong when the dollar is also showing strength?
Gold is benefiting from two very different drivers that just happen to align right now. First, continued geopolitical risks are fueling systemic fear. We've seen specific reports related to the Venezuela situation and U.S. action there, which tends to drive this generalized global instability fear. And gold loves fear.
Right.
Second, while rates are high now, there is this persistent long-term anticipation of eventual Fed rate cuts. Once rates start falling, gold, which yields nothing, becomes drastically more attractive compared to treasuries. It's an insurance policy against global chaos and future currency debasement.
Okay, let's pivot to oil then, because the data shows a clear divergence. Gold is soaring on geopolitical risk, but WTI crude futures dropped to about $56 a barrel. Why didn't oil follow that gold fear?
That's the difference between a broad systemic fear and very specific supply news. Gold reacts to the general potential for instability. The crude oil price, in this case, reacted immediately to tangible supply shifts. Specifically, reports that Venezuela might resume shipping oil to the U.S. That eased some of the immediate supply tightness. Oil is just much more sensitive to immediate supply and demand changes than gold is.
So this raises an important question. Where does cryptocurrency fit in? It sort of straddles that fence between speculative growth and digital gold. We're seeing Bitcoin, BTC, trending up near, 93 to 94,000, and Ethereum, ETH, near 3,200. The strength is definitely there.
The momentum is there, yes, driven largely by technical factors and increasing institutional acceptance, especially with the new investment vehicles. However, the internal sentiment is still cautious. If you look at the Crypto Fear and Greed Index, it has repaired itself from extreme fear, but it's still solidly in the cautious or fear range, around 30 to 45.
So the price action is a bit fragile.
Very. It's heavily dependent on specific technical flows from the options market and, crucially, sustained inflows into those institutional ETFs. This recovery is tentative. It needs continued institutional validation to really solidify.
And before we get to strategy, we have to just briefly touch on the high-risk corner. the private secondary markets, or what the data calls pre-stocks.
Right, so we're talking about the market where stakes in late-stage unicorns like Anthropic and OpenAI are traded before they ever go public. This is a very high-risk, very small allocation segment. The valuations are just staggering. OpenAI pre-stocks around $10.50, and Anthropic is trading near $3.15 to $3.25.
And the risk there is?
The takeaway is the extremely high volatility and the fact that you see significant price differences across the various trading platforms. That complexity just underscores the high liquidity risk in this highly opaque sector. This is absolutely not for mainstream capital allocation.
Okay, let's move to synthesis. We have this dual nature: relentless pressure from long-term high rates, chaotic short-term liquidity, and capital splitting between high-octane growth and maximum defense. What's a temperature check? The VIX, the fear index, is actually pretty low, around 14.8 to 15.
That VIX reading is deceptive. It really suggests a surface-level calm, but imagine standing on a financial fault line. The surface looks calm, but the pressure building underneath that tension between rates, liquidity, and capital flows suggests a very real risk of sudden, sharp upward volatility.
So what does this all mean for you, the listener, trying to navigate this paradoxical environment? If the market is schizophrenic, your strategy has to mirror that, right? It has to be balanced.
It must. The synthesized strategy is simple in its mandate, but complex in its execution. Defense first, phased entry, and strictly managed risk. You have to respect the continued pressure from those high long-term rates.
So let's break that down. What does defensive positioning look like, especially when you're trying to balance it with that AI growth thesis?
Defense means two things. First, use broad-based ETFs, VOO and QQQM, as your systemic foundational anchors. They give you market exposure while spreading the risk. Second, and this is crucial, maintain flexible cash positions and manage short-term treasuries. Don't view cash as idle money, view it as dry powder. It allows you to deploy capital quickly if a rate or liquidity event creates a dip.
And for that high-octane growth side, the NVIDIA and Meta trades,
Yeah.
how do you approach those without getting completely exposed to that rate gravity?
For those AI leaders, a phased entry approach is mandatory. You do not jump in all at once. You commit a portion of capital now, and you reserve the rest for further entries, especially if macro data causes a shakeout. And because valuations are so high, you absolutely must consider option protection, like buying puts, to manage that downside.
What about the hedge against systemic risk? That can't just be a footnote.
It absolutely cannot. Your hedging strategy has to be intentional. We recommend a specific small allocation to gold ETFs or even limited physical holdings. Gold's performance is acting as a direct counterweight to the systemic uncertainty.
And finally, crypto. We noted that momentum, but it's still in that cautious fear zone.
For Bitcoin and Ethereum, we still recommend small, phased entry. Dollar cost averaging, not trying to time the market, and strict stop-loss orders are essential. If you're participating, you have to follow the institutional ETF flows. That is the lifeblood of this current recovery. And as for pre-stocks, if you choose to participate, it must be minimal exposure with very clear exit rules defined before you even get in. That is risk capital only.
The opening of 2026 is truly defined by this strange dual reality. You have incredible momentum in AI and semis running parallel with this profound systemic caution expressed to the strength of gold.
And we expect short-term volatility to just be amplified by every piece of geopolitical news and every single macroeconomic data release.
And this leaves us with a final provocative thought for you to consider. So what does this all mean for the structure of global finance?
Given this split capital flow, the US dollar index, the DXY, is actually showing short-term strength, trading around 98.5. How long can global capital continue to flood simultaneously into two opposing camps, dollar-denominated growth assets like tech, and anti-dollar hedges like gold and crypto, before one of those dominant trends definitively breaks the other?
That tension, which cannot last forever, is what will define how this market resolves over the next several months.